Right, guys, we'll make a start. So, a series of 4, potentially 5 webinars. So, we'll be covering Edge, which is basically the strategy that you trade. It's basically your edge over the market. How can you consistently take profit from the market? Execution will be the next one. There'll be times where your strategy works perfectly, and there'll be times where it doesn't work at all. Now, a lot of traders come into trading and they'll take some technical analysis course and they'll go away and they'll just execute that strategy exactly how they've been shown, which is great and it works a lot of the time. Like I said before the call, it's not a strategy bashing webinar because every strategy can work. Even what you would think is a crappy strategy, there'll be people all over the world making millions using that strategy, because it's all down to the individual. You are the edge, the trader is the edge. You can't take a strategy off somebody. Somebody cannot package a strategy for you to learn and then go ahead and trade successfully, consistently over time. It's just not. It's not possible. A lot of people go into signal services. Again, I used a good example the other day on a call that, you know, these YouTube videos where people go round and they ask people in nice cars with nice houses, like, and they're wearing nice clothes, what they do for a living, and then they have conversations with these people. I wanted to make a video that went round asking people what they did for a living, and all of them made their money from a signals service in Forex. Just because, obviously, it would be an ironic video because nobody in the fucking world has made it in life from following signals. So what's the point? You're the edge. You need to mold yourself until you found an edge in the market. You can take a strategy and via journaling and a feedback loop, you can mold that strategy to yourself, because you need the two. You need the strategy and you need you, and they need to be entwined, because you are the edge, not the strategy. So having a strategy that you can use and you don't have any flexibility in that strategy, again, there's big negatives in that, because it's going to work a lot of the time and then other times it isn't going to work. Now, we have different market phases all the time, so if we just pull up some charts just there. So if you are a 4-hour, if you take the majority of your trades on the 4-hour, EURUSD is in a sideways market at the moment. That is the current phase that it's in. If you are a daily trader, I'd say, yeah, it's probably, you know, this was trending higher here. So what I'm getting at is that, does your strategy perform in a, where's my pen gone? In a trending market? Does it perform in a sideways market? And now, all depending on the time frame that you look for your execution from. So if you look for trades on the 15-minute, the market's essentially trending downwards here. So does your edge perform in a downward trending market on that particular time frame? There's no point looking at the daily and then finding out what phase that the market is in when you execute on the 15-minute and you get all of your trading information from 15-minute charts. It's pointless. So you need to know if your edge performs in all the different types of markets. So a trending market, a sideways market, and a event-driven market. Now you always have an underlying, well, you don't always, but for large periods of time, you have an underlying driver in markets. For example, the first big one that I encountered was Brexit. So there would always be Brexit news which would drive the pound one way or the other. And I always remember sitting on the screen and the news was on because there was a meeting going on in Downing Street. And the pound started rallying. And then, because the news feed is obviously, the news programme was slightly delayed, the market starts going higher, pound, and somebody walks out the door in Downing Street and smiles. And the pound rallied because the politician smiled when he came out of the door. This is an extreme example, but we would get EU politicians making comments which would drive the euro or the pound, and it was all the time up and down. Next election, Trump's first election, that caused chaos across the markets. After that, I'm probably missing a few things, but the start of the war in Ukraine, I remember euro, New Zealand dollar, antipod pairs just went down for days. When did it start? Who knows when the war in Ukraine started? I'll have to Google it because I want to find the chart just to show you. February 24th of February 22. It's interesting to go and look at these. Yeah. So this, obviously there was a bit of tension around beforehand when the troops were amassing along the borders. And then 22nd, which is here, which is the market sells off. Now, does your strategy perform in this? You know, this is why it's important to know what's driving the market. Sometimes it's just stocks or yields driving the market for a short-term move. Other times it's a global event which is causing a repricing of funds across the world. So, and the market will just go and go and go. And then after Ukraine war, most recently the next election and the tariff situation. So if you think that you could just get one strategy and trade that strategy the same all the time, you're going to get periods of drawdown. Now, it's fine. Some traders are happy to just continue to trade their strategy because over time, with their risk reward and their risk management, they can still be profitable, but they will experience periods of drawdown. Now, you can have a day, a losing week, losing month, multiple losing months, which happens to traders, professional traders. But they're still executing their strategy, and over time, they're still up, and they'll be up again in the future because they've got the confidence and the knowledge to continue to execute their edge. Now, it's pretty extreme months and months of drawdown, of course. This is why I prefer to be to not follow a rigid mechanical strategy and just have that discretion. It's discretionary trading. It's you can be selective over the trades that you take. Now, if you're trading if your edge is mechanical and you have to take every setup that you see, then that is fair enough. But for me, if I have a setup on Euro New Zealand dollar and it's tanking because New Zealand dollar is rallying, so New Zealand strength, obviously Euro New Zealand would be dropping, I am not going to take a trade on Euro New Zealand dollar until New Zealand dollar US dollar stopped. Now, people with the mechanical strategy, they only look at the pair that they're trading on. But in my opinion, if you can have that discretionary side of trading where you can select a trade or adjust the entry according to what's happening across the markets, that is when you can really excel and avoid those periods of drawdown. So New Zealand dollar, US dollar, we would wait for that to hit a level and then we'd execute on Euro New Zealand dollar. And now sometimes that may mean that if we're looking to buy here on Euro New Zealand dollar, and prices coming down, New Zealand dollar, US dollar still got room to run to its level. That means we could end up executing the trade that we wanted to take here. We could end up executing here. So when New Zealand dollar, US dollar hits a level, we then buy Euro New Zealand dollar here. Now you can take the trade on New Zealand dollar, US dollar if you want, but the volatility compared to Euro New Zealand dollar is a lot less. So quick look at ATR. The distance of ATR Euro New Zealand dollar is 240 pips. Now New Zealand dollar, US dollar is 100 pips. So we're going to get 2.5 times the move roughly. So if New Zealand dollar, US dollar pulls back 10 pips, we're going to see 25 pips on Euro New Zealand dollar. Obviously, if it fails, then it's going to fail 2.5 times more pips. But waiting for New Zealand dollar, US dollar to hit the level massively puts the probabilities into your favour. So it's about having an edge. Even if your strategy is based on a low time frame and it involves moving averages or fibs or anything, if you want to buy Euro New Zealand dollar at a 61 fib, but it's getting there because New Zealand dollar, US dollar is driving, you don't execute from that fib. So this is how you can bring the discretionary side into every single strategy that's used across the markets. It's irrelevant whether you are a levels trader or you trade based off indicators, I don't know, Bollinger Bands or whatever. Even if you are a smart money concept trader. Again, people, including myself, have a lot of shit to talk about smart money concepts, but there's people out there who are smashing it, who are genuinely making serious money from it, and it isn't because smart money concepts is the be all and end all, because it's only as good as the next strategy. It's the trader himself, her or herself, that is the edge. It's nothing to do with the strategy. The strategy just gives you an idea of what to do and where to find areas of interest in the market where you'd like to interact with the market by taking a buy or a sell. But again, even if you trade smart money concepts and you've got a setup coming and market flows are in play, you just avoid that trade, because you can then increase your success rate massively. Now, when you first start out, there'll be times where you'll think that the flows are happening and you won't take a trade, and it'll play out and you'll get annoyed and frustrated. We can't have too much focus on recency. We really have to get big data sets. Now, I see some people saying, "Oh, I'm going to do this for a week and see how I get on." It's not enough. This is months, if not years, of hard work. And when I say hard work, it isn't hard work as in you've got to be really active in the market and you've got to always have a trade on. You've got to try and find which way the market's going to go next. The hard work is the journaling and the data collection and finding out what mistakes you make. Why do you make the mistakes, which is something we'll go on to in the emotional control webinar. A lot of these webinars will have stuff that crosses over, and that is why there's the multiplication factor of 0. So if one of these subjects in the webinars is lacking, you'll be a break-even trader. You won't consistently make money from the markets, because you multiply anything by 0 and the outcome is 0. So if your edge isn't right, if your risk management isn't right, if your execution isn't right, so that, I mean, if you just execute everything you see without any sort of awareness of why the market's moving, you're going to execute yourself into drawdown. And then the final one, psychology and emotional control. Like, if that isn't there, you will not be able to follow the plan. So again, a lot of traders who will be watching this will be break-even traders. And I say to people who are break-even traders that you're already better than most traders. It's actually something to be proud of. There's just, once you start journaling and taking into consideration market flows and having that solid emotional control, solid psychology, things really come together. So back to your edge, your job as a trader. It's basically to identify, watch, wait, and execute. So if you're trading off the daily chart, you could look at the market on a Sunday and find all of your areas of interest, and then potentially look again at the market in the mornings just to see what new price action there is. So if we go into the daily on EURUSD, you can see that on Monday we had a move all the way down to this candle close. So we retraced the whole of the previous day on Friday, and it offered an opportunity. So if you'd have looked at that on Sunday, you might not have considered it, but then when price developed throughout the day, opportunity came around. But if you trade the 15-minute, you're going to be asked to updating your chart every hour or so, at least. So it is hard work. But if you're on the 4 hour, I'd say you can just update on a Sunday, and then once a day. It's those trades that you go looking for, hunting for setups during the trading session that you didn't see, that were not in your plan in the morning. They're the ones that kill people, that kill your profit margins. If you set a plan up in the morning and then you've added a trade to that, you've taken a trade that wasn't in that plan, you should have a column basically to keep a track of that, column in your journal to keep a track of what extra trades that you took, and then record the performance of those over time. Now you might find that that's your most successful, the most successful trades that you find are found during the trading session, which were not apparent, or the tech wasn't there before the London session started. So this is what I mean about, I'm not going to batter any sort of strategy or any process. It's down to you to find out what works for you. So there's a lot of sitting and waiting. And sometimes it means sitting and doing nothing for a whole day, if not more. So you've really got to fill that time with something constructive, different tasks and processes. So if you've got like something you've been putting off for a while, I don't know, booking an appointment, doing something that's going to benefit your life outside of trading, doing admin, bills, anything like that, you've got to be productive, because sitting on the screen watching price on the lower time frame, you can't watch a candle and then decide which way the market's going to go. In my opinion, it's impossible. Basically, the market will move from your technical analysis to your next area of interest, from one to another. But in between those areas, all the market is doing is advertising for liquidity. It's advertising for people to come in and buy and sell, so it continue to move where it wants to go. So these intraday moves, the moves in between the bigger moves, all they are is the market saying, this is what I'm going to go this way, and then it'll go the other way. It's just advertising for liquidity. It's not a strategy to go down the lower time frame and you see the market starting to go one way and then jump on the move. So don't look. Alerts will be your best friend. Find your areas of interest, set your alerts, and then go away until you get an alert. Got to have... Some people say they completely ignore the news. Some people, their whole trades are based on news. But what you really need to know is if the market's moving, why is it moving? Because we might just see EURUSD moving higher because we got dollar weakness. It might be off the back of NFP. It might have been that NFP came in 5k below the estimate, which isn't much. So it's likely that you would take a trade off the back of that data when price gets to your level. But if the market's moving because it was 150,000 below, then you're going to rethink. So you need to know what the severity of the event that's causing the move. Like Powell on Friday, he mentioned that there may be a different approach to monetary policy with lower rates, and then the market just went against dollar straight away and moved. So we know straight away when Powell's mentioned about interest rates, it's going to cause a strong move. So any sort of setup that you've had in here, let's pick on fibs, for example. You might have had a trend line going down here which dissected a fib, which you thought would have been a good trade to take. But because of that move, the reasoning behind it, you've got to just pull that order because of the severity of what's been said. So obviously a lot of sitting around waiting, but when your alerts start going off, you need to find out why the market's moving to your area of interest. If we're still in a subdued market, then yeah, take the setup, but you've got to be considering why the market is getting there. Now, which obviously I've mentioned that earlier on, a lot of traders don't consider why the market's getting there, and they'll just take the trades and they'll rely on their risk-reward ratio and their risk management to make money over the long term. But again, there'll be a lot of waiting, and trading at one point will affect your relationships, and your relationships will suffer because you will become consumed by the markets from time to time. So if you can be productive and work on things outside of trading when the market is subdued and there's not much going on, not much action, it's not really your edge, but it can be your edge in life. Have a jobs list, have a list of tasks which you write down before or after you're doing your analysis on a Sunday or a Monday morning for the week ahead. And I'm not the person to give life advice, but sit down with your partner or your children or whatever. Is there anything that they need that you can do? Because if you've got a good relaxed home life, then your trading becomes easier, because we'll get onto this with the emotional control in the last webinar. If you're in a good place mentally, your trading will reflect your mental state. So to get this is bordering into execution now, but you need to have your routine. You need to mark up your areas of interest for the day, and then just sit on your hands until they come into play. You need to know what you want to see. You need to know the scenario and the market conditions that you want to see when price gets there. So for example, if you are looking for an intraday level, or what you might class as just a lower time frame, weaker setup, you need to know why, the scenario in which you would take that trade. So you note down the area of interest, you note down that you would only take this in a subdued market. And then if you struggle with drawdown as well, it's something that we'll cover in the quickly look at journaling. If you struggle with drawdown and most trades that you take end up going into drawdown, start looking at getting into the market as close to being wrong as possible. So what I mean is that there was a good example of it today, actually. There was two, actually, because I was in a trade that it happened to. There was pound New Zealand dollar today. So people would generally mark up this level, the extremity here, and put a stop outside that. Generally, the market will come up, come down, take out that low, take out that high. If you expect that to happen, then that should basically dictate where you want to enter the market. The amount of times that I've taken a trade like 2 or 3 pips past a level when a lot of the market is getting out, but that's the reason why the market drops, because if you've got sellers that are then offloading their positions, if you're offloading a sell position, that is a buy position. If you're to close a trade, is you taking a buy because you're buying back your sell. Somebody needs to be on the other side of that. So the people who are sitting just outside that level, like on pound New Zealand dollar today, will take those closing sell orders, and then the market will drop and do the move that a lot of traders are waiting for, and then cause no end of frustration. I just want to touch on as well, trading the market and not your P&L. So trading your profit and loss, basically trading the numbers, trading the money, trading the percentage on your FTMO or your whatever trading challenge that you're taking. The amount of times that I've seen traders not close out on trades because the profit in that trade isn't enough to satisfy their desire. Okay, if I had £1 every time I saw that, I'd have at least £20. No, I'd be a rich man. So traders, especially since these funded prop firms have become so prevalent, people are making all the decisions based on their desire to get that percentage target. When every decision that you make has to be made from the charts. So you take what the market is giving you. If you're in a pound New Zealand dollar sell, and it's fair game if you haven't taken profit now, but I personally have taken profit because it's come to this level here, and that was my first area of potential struggle, and the market has consolidated there. Now I would not be surprised if the market did continue. When you're in a trade, don't expect it to just go all the way to your target. The market moves in cycles, and what did I say earlier? It advertises for liquidity all the time. So for the market to keep continuing down here and not in a non-flow scenario, so just in standard market conditions, there isn't enough selling to get all the way down here. Now if this move was sentiment driven and there was New Zealand strength and New Zealand dollar, US dollar was moving higher, this would quite easily keep going because they're in a flow scenario. But because we're in a subdued market, you would fully expect the market to do something when it got here. Again, this wick here, there's probably a level, probably an intraday level in that. Oh, it's just been missed, so by a few pips. But you would expect the market to do something when it came here. And that is exactly what happened. Doesn't mean I'm going to buy it. You could do if you're that way inclined, if you liked a bit of risk, but I don't know how far the market's going to come down into this area for me to execute. So that's why I only use buy pressure for buys. So I wouldn't trade this retest. I would wait for the market to slip all the way through to this level here for me to take my execution. I didn't get there, so there was no counter trade for me personally. Now, when the market gets, if it does continue down here, if you don't take profit there, you're a fucking idiot. The only reason that you should not take profit here is if flows are in play and New Zealand dollar, US dollar is moving higher and it hasn't got to a level yet. But as soon, so it's basically the opposite execution for, exactly the same execution for entering in a flow driven market. But you can use it to your advantage. So if it's likely this level would get passed because of New Zealand dollar strength, then yeah, hang on to it for a little bit, see if it'll go past. But you're not trading your desire there, you're trading the market. every decision that you make has to be based on the market and what the market conditions are and the charts. If you ever hold a trade because it doesn't look like enough profit, or you need an extra few $100 to pass your FTMO challenge, that doesn't work like that. It might happen now and again, but you have to take what the market is giving. You have to make every trading based decision via the charts or market conditions. It's absolutely imperative that you do that. And then journaling. I'll finish on journaling because I don't want this to drag out for too long. If you've got any questions, just fire them in, or any observations from your own trading. If I've discussed anything that you thought, yeah, that's me. One of the most important things in trading is for you to be able to just hold your hands up and say, yeah, I do this. Not to me, not to anybody else, but to yourself. If you can do that, you can then put things in place to stop you from doing it. So journaling is so important. It helps you find bad habits. Have a bad habit column. Let's just show some of the data collection documents that we use in Traders Pathway. And these aren't just for people doing a performance coaching. Everybody should be using these. You know, you can add anything you like into these data sheets. So a little bit of personal stuff at the start. Anything going on in your life that's going to take your focus away from trading, very important. Important things to focus on in your trading today. So if you've been making any mistakes, expectations for the market, what do you think is going to happen today? Any setups that you're looking to take, note them all in there. Put screenshots in. What actually happened in the market? I didn't take any of the setups that I had looked for this morning, but I did my ass selling cable, and then I quit trading for the day, and then the setup that I was actually looking for, the cable sell, worked. Things like that. And that's, you know, it might be joking, but fucking hell, that's probably a lot of people, that probably describes a lot of people's trading days every day. Like trying to trade in between the moves because the market's a little bit subdued and it's not moving fast enough and they want some action. And then inevitably, by the time the market gets to the level that they initially wanted, it works. So they could have just sat on their hands all day, done a few things, done a bit of admin, done something nice for your partner or your kids, walk the dog, come back, price is at your level, take the trade, done. Trading, it's actually a pleasurable experience when you follow your plan. Even if your plan has got you in drawdown, if you're journaling and noting everything down, there's nothing wrong with that. There's nothing wrong with being in drawdown. If you're in drawdown and you haven't got a fucking clue why, and you're not noting things down, that's when you should be worried. Like this, the rise of this, these funded accounts, online funded accounts, they've basically destroyed the mindset of new traders. Because I just wanted to show this little amazing document that I made earlier. Prepare to be wowed. Oh, don't tell me it's gone. So this, it's just about confidence. I stole this idea off a famous online trader online. And this can work for several different. You can change these words for a few different versions. So ask me, why don't you follow your plan? Why aren't you taking only planned trades? Well, I just want to get this challenge passed, and then when I'm funded, I'll then be better at sticking to my plan. Now, before these funded accounts come along, it was once I build up my capital, I'll then start trading properly and trade my plan. So it's like people want to just gamble up to a certain level, and then they think that they'll then start being responsible and trading correctly. And then it's the same with, you're not confident. Well, why aren't you confident? What will it take for you to become confident? And I'll become confident when I get consistent winners. But then you won't get consistent winners because you're not confident. See, it's a loop. Everything in trading, you need to look at it as a loop, a feedback loop. This one loop you need to break, or you need to add things into it to become confident. Like, can you follow your trading plan? Note down in the morning the opportunities that you're looking to take. If you take anything that was not in that trading plan for the day, you've broken your loop. Now, there's some occasions where I'll take something I wasn't planning on taking during that day. But that will only be if I look through the market and there's been a move on antipods and both of them are sitting at a level. Cables at a level, EURUSD's at a level. Everything across the market is sitting at a level, and I'd be fucking stupid not to take it. But that will all be journaled and documented. But the levels that I would be trading from would be marked up in my chart. I'm not just trading from thin air. So if I've already got the level on the chart, I'm still trading my plan. It's just that I wasn't really interested in that scenario in the way it came about. If that makes sense. So again, your edge, you can get any sort of strategy, and this is why I'm amazed that the channel hasn't grown. I'm not amazed because I don't do any marketing because I fucking hate selling, and I fucking hate people in general, and I hate the forex industry. I feel anybody who trades any strategy would benefit massively from just knowing when we're in a market that is not conducive to taking trades. If you can learn that, then your trading is going to improve massively, and that's what I do all day. Literally, when market flows are happening, I'm in the market update channel. Dollar's moving because of stocks or because of yields, or it's just a dollar move or antipod strength, and then you should be able to just pull the plug on anything that you're looking to take until those flows are stopped. And that should be a caveat in your plan every day that I will not take this trade if flows are happening. So if you're going to try something anyway when flows are happening, you're breaking your plan. So even if it was a setup that you've got marked up, you should know whether you're going to take that setup in a flow scenario or not. So you would say, if I'm going to take this pound New Zealand dollar setup, if it's in a flow scenario, I'm only going to take this when New Zealand dollar, US dollars at a level, when the driver is at a level. And you're generally not going to take your execution from the tech on that currency pair anyway. So you're going to just sell it or buy it when the driver hits. So considering risk and sentiment moving the market in my opinion, is the biggest reason for traders, for the high failure rate of traders. And loads of people have got their own different opinions of why the market, why so many traders fail. And generally, there's no right or there's no wrong. But from what I see, the evidence that I see, it's never a trader that sticks to their plan that is struggling. It's always a trader that breaks their plan and fights against strong moves and loses their mind that causes traders to fail or blow accounts. It's always the same thing. I never see a trader that's on his ass and his account's well down because he's followed his plan and he's executed only the trades that he planned to take. It's always because of trades that are not or in the execution, in the risk management. There'll be a section on traders being in drawdown and then doubling up. So you've taken a trade that you had planned to take, but you took it in the wrong market conditions, and then you'll think that the market conditions have now changed, and then because you're in drawdown, you think the move's going to turn now. You'll then take another trade, effectively doubling your risk. And this is a scenario that I see most, and that's the scenario that killed me in the past a lot of the time, because I'm trading what I think and I'm not trading my plan. I think I've covered everything I wanted to cover on edge and strategy without being strategy specific. Hopefully it's given people something to think about. Next call tomorrow night, we're going to talk about execution, and that's basically pulling the trigger. I know we've covered that a little bit tonight, well, quite a lot tonight actually, but we'll cover it tomorrow with some examples as well. So if anybody has got any setups that they're interested in tomorrow, just stick them in the channel and we'll have a look at them on the call. Or any trades that you've taken recently that have lost, that you thought were a banker, put them in, and we'll review them on the call, or send me a direct message and I'll compile 2 or 3 and we'll have a look on the call tomorrow. See if there was any reasoning for you to have not taken that trade, because in my opinion this is the most important part of journaling. So that's what we'll have a look at tomorrow. So if anybody's got any questions or wants to talk about anything that I haven't covered with strategy, just drop a message now or use the open forum. Or I'm putting this on YouTube, so comment and I'll get back to you. So cheers guys, I think that's it then.